Hello, hello, everybody. Welcome. We're going to give a few minutes so that everybody can log in. Happy Wednesday. Hello and welcome. Just giving a few minutes. Thank you so much for joining us on this Wednesday afternoon. So I'm going to start. Thank you so much for joining us. My name is Lorna Baez, and I'm the Assistant Director at the Small Business Development Center at FIU. Because we love acronyms, we are well known as the SBDC at FIU. And today we have one of our consultants, Lillian Urban, who's going to lead this workshop. She's one of our consultants here. And please know that we provide no-cost consulting services that are confidential to help your business needs. So I'm going to go to the next slide. Just so you know, and you see like my background, the SBDC here at FIU, we're located in Brickell Ave. We are part of the overall SBDC network, which is funded by the federal agency, the U.S. Small Business Administration. You will find SBDCs all around Florida. We at the SBDC at FIU, we provide services to Miami-Dade and Monroe County, meaning also the area in the Keys. But if you are in Broward or any other place in Florida, please know that there are SBDCs here to assist you as well. And then, as I had mentioned before, other than providing workshops to the community, we give a lot of workshops about everything from accounting to starting your business to marketing to government contracting. We also have the one-on-one consulting services. So Lillian is one of our consultants. She's going to provide you with incredible information today to help your business accounting. But if you ever want to meet individually with somebody like her to speak specifically about your business needs, you can always register with us, and then you can start the one-on-one consulting process. We have all kinds of consultants that have very specific specializations. So feel free to contact us. We are here to help. So I'm going to now give the microphone to Lillian so that she can lead this workshop.
Good afternoon, everyone. I'm so happy you guys are making the time to learn a little bit about basics of accounting in 60 minutes. That's the title of this PowerPoint presentation. But with that in mind, I just want to, before I start, I would like to make a very important disclaimer. The information is intended to provide insight on basic accounting faced by small businesses owners. It is not possible to cover all scenarios or circumstances. That's when you come in and you talk one-on-one, like Lorna explained it to you. There are many things, considerations, a step that you will want to make follow-up to include it in this webinar. I believe you will be receiving the PowerPoint presentation, and I believe this is being recorded for your information. For assistance in better understanding accounting principles for your business, it is highly recommended that you become familiar with FASBA, which is the Financial Accounting Standards Board. This is an independent, not-for-profit organization responsible for establishing accounting and financial reporting standards for companies and non-for-profit organizations in the United States, following GAAP, which stands for Generally Accepted Accounting Principles. GAAP is a set of standards that companies, nonprofits, and governments should follow when preparing and presenting their financial statements, including any party transactions. With that in mind, let's start the basics of accounting in 60 minutes, which is what are the accounting principles? Accounting principles are the rules and guidelines that company must follow when reporting financial data. This rule makes it easier to examine financial data by standardizing the terms and methods that accountants must use. All accountants must follow GAAP. Why? Because it is a standard nationwide. I'm not talking about Florida. I'm not talking to any other state. I'm not talking just the US state. It's nationwide. What are the accounting principles? It ensures that a company financial statements are complete, especially consistent and compatible. That is why financial statements are nationwide similar, because you can compare one industry with another or within the same industry. This makes it easier for investors to analyze and extract useful information from the company financial statements, including trend data for over a period of time. So you can have a financial statement for 1 year, you can have for 3 months, per month, and you can compare it to the prior year, and you can determine whether, let's say you're doing a budget, whether you are going to be increasing the sales because now you have data to work with. It facilitates the comparison of financial information across different companies. So when I said industry, I mean, if you own a beauty parlor, that's an industry. So you can compare financial statements, which will be prepared with the same GAAP guidance. It identifies and increased transparency and allows red flags to be identified and eliminates accounting fraud. This is very important because I know most likely you are a very small business, or maybe you haven't started a business, and let's say in the future you qualify for a loan. This will eliminate people just making up information. For example, in my practice, if someone comes to me and says, okay, I need you to prepare the financial statements, and they say, oh, you do this for me because I'm going to get a loan. And I said, you know what? You need to find yourself another accountant because I'm not going to do that. It eliminates the accounting fraud. You have to find someone that is really honest and consistent and that follows GAAP. Accounting standards are critical for ensuring the management, bankers, or investors that are not led off track for misleading financial statements. That's why the investors, they know the industry most likely, and they have seen other financial statements. So they're going to make comparisons. So if they see a number that is totally out of whack, they're going to say, what is going on in here? I'm not going to do anything for you. What is accounting? Accounting is just a system of recording and summarizing business and financial transactions in a report, also known as financial statements, which allows you to analyze, verify, measure, and quantify financial information to make informed business decisions. If you're going for a loan, the banker is going to determine whether they give you a loan or not. If you're doing it internally for your services or for your acknowledge, or because you're planning to grow, you will make informed business decisions. An accounting system identifies, records, and measures accounting transactions by a system known as a double entry accounting system. That's what's called the T account. We will go over the T account later on, but it's known as a double entry because every account has to, in order to have a debit, you have to have a credit. And if it does not match, you can have 2 debits, you can have 1 credit, you can have 1 credit, you can have 3 debits, but the total has to be the same. I will go over an example and teach you what I mean with this information. This is just general information. Like it says, composed on debits and credits, and the debits and credits must equal by the system to remain balanced. Again, I will go give you an example. The father of the double entry system of accounting is Lucas Bartolomeo de Pacioli. I love Italian names. De Pacioli, I love it. He was the first person to publish detailed material on the double entry system of accounting. He was an Italian mathematician and Franciscan friar. He had the time. He had the time to do this, a very intelligent person, I believe. What are the different types of accounting? We have financial accounting, managerial accounting, cost accounting, auditing, tax accounting. What's the difference between them? It depends on what you are doing. For example, financial accounting is the process of compiling information for financial report for external reporting. For external reporting, that will be a bank, someone you're going to bring in as an investor or another member or another shareholder. That will be financial accounting. Managerial is for internal. It's for internal shareholders and members. They call them stakeholders rather than the public. Internal managerial accounting is to determine where you stand in your business. Are we being profitable? Are we making enough money? Are we spending too much money on certain items? Is the analysis, it's managerial, it's for internal stakeholders. Cost accounting is very interesting for me because that's what determines what the price of the items that you're selling is going to be and determine what should be the markup. If it costs you $10 to manufacture or put it together, should you sell it for $20? Should you sell it for $30? Should you sell it for $40? It all depends on demand and what the industry sells for, because you want to be competitive. You don't want to just come up with a number. And that's where we come in. We have other consultants that will help you. I will help you the same. I can teach you about cost accounting. And then the markup, what it should be. But we have excellent consultants that they will teach you as well. Auditing. What happens with the external auditing? Auditing is performed by an external company. They look at your books. They review your books. They make notes on it, and they make a list of notes and let you know, after they ask you several questions, whether the books look good, on what you should do, what you should consider. There are different types of audits, and they're very expensive. So if you are with us, with the Florida SBDC, we can teach you how to keep good books so that in case if you need to have an audit done, it minimizes the time the auditors will spend doing the audit, because it's very, very expensive. And then we have tax accounting. In my practice, I'm a tax accountant, right? Because I do the accounting, the compilation, but then I have to make some changes, some adjustments to bring it into the tax accounting mode to prepare tax returns. It could be a corporate tax return. It could be an asset status corporation. It could be a partnership. It could be a trust. Tax accountants assist businesses to stay in compliance with the IRS when filing their tax return. They can assist companies in planning for future tax returns, such as understanding the implication of certain tax decisions. And that's very important. Just learn that if you're going to do the accounting, you still have to have a CPA or a good accountant that can go over with you at least every 3 months where you stand with your business. We do that as well. We are not allowed to teach you about tax returns, but I can guide you through the process and give you ideas. And what I do mainly, and even in my practice, I teach my clients, and I have taught this at my clients within the Navigator program and now the SBDC before and now will do the same, is how to read tax returns so you understand where you stand in comparison to what the financial statement says. The different types of accountings required information system. Accounting information system is a company system to post transactions and restore and process its financial and accounting data. The most popular ones right now is QuickBooks and Sage. If you were to pick between the two of them, the price is about similar. The only difference is that in QuickBooks, you can make changes to it. It's more user-friendly. And that's something that we at the Florida SBDC, we can train you with QuickBooks. Many accounting information systems integrate other departments such as human resources and payroll functions to decrease the manual entry of information. Nowadays, with technology, nobody does general ledgers by hand. I remember years ago, that's how I started, with a pencil and a 4-column ledger, but that was years ago. Now we don't do that, but it helps when you are working on your T accounts, when you're doing journal entries, if you understand your debits and your credits. Forensic accounting is very critical and is used to investigate the financial record of individuals or businesses. Many times forensic accounting is done because there's a divorce, there's a husband and a wife married and they're getting divorced, and either the husband or the wife says, oh, no, he's hiding money. So that's where you hire a forensic accounting to determine whether the books are clean or not, because many times not both of them are within the business, working in the business, as well as businesses. Forensic accounting, they're trying to determine whether, people are lying. And that is we need to avoid fraud. You do not want to deal with the IRS or the state of Florida or anything like that just because you don't have a good person or a good background in learning how to use a software program like QuickBooks. Public accounting refers to businesses that provide accounting advice and assist with auditing. Public accountants, CPAs, they go in and they help you do it. Now, because most likely, I don't know, I'm just making an assumption, maybe you're a small business. Do you need a CPA? Yes, there are many CPAs out there that will take small accounts, but there are large corporations, large CPA firms that will not. They will not. For example, I used to work for PricewaterhouseCoopers, which is one of the 4 largest CPA firms in the world, and they will not take the little accountants. So when I resigned, I said, okay, can you give me some of those accounts that you don't want to deal with them, because it's the same quality of work they provide to the large company and the small business, but they don't want to deal with such a small businesses. Governmental accounting has its own standards that must comply with the government accounting standard GASB. GASB is for the government. This GASB is responsible for developing consistent accounting procedures for local and state governments. Now, federal employees, meaning the accounting department within any university, they have to file GASB, okay? In conjunction with FAS, with the Accounting Standard Advisory Board. This is all related to government accounting. So if you have a non-for-profit, you have to follow those agencies. In business, we have our own jargon, our own language. I always recommend learn the jargon, and that's how I train my clients. I teach them the accounting jargon. So when I talk to them, at the beginning it's new, and I said, okay, take notes. But then at the end of the day, I said, oh, you have to send me the 941, you have to send me the W-2, you have to send me the 1099, because I took the time to train you. There are three languages: accounting, finance, and economics. While there are other areas business are important and essential, such as human resources, marketing, operations, business decisions are made by interpreting the financial statements, such as the balance sheet, the income statement, and the cash flow statement, which are called financial statements. We will go into more detail later on this presentation. Accounting plays a vital role in running a business because it helps you track income and expenditures, ensures the statutory compliance, and provide investors, management, and government with quantitative financial information to make business decisions. You see in here, this paragraph is like a summary of what I had explained to you, what happens when you have the accounting, the different types of accounting, and who are affected by it: investors, bankers, management, and the government. Because just because you have a non-for-profit, especially if you're going to get a grant, you need to have those financials. And let me tell you, they're required to be audited. It is critical to understand your client, where they stand with demand, and how you will supply that demand. You need to know who your clients are, what their needs are, and it takes a huge role in the type of business you want to open, and mainly, very important, if you have the experience. What do the clients prefer to buy, and for how much? So how much will be the cost accounting, right? We need to determine how much it costs, what's the demand, and what else, and what is that other your competitors are selling the same product for. This is more hands-on, and what is that you need to use, let's say in a program like QuickBooks. You need to enter your vendor bills and categorize the expenses. Record the payments when you pay your vendor. Send your clients an invoice. Now, let me just stop here for a minute. The IRS gives you the opportunity to going to prepare the tax returns either in the cash basis of accounting, the accrual basis of accounting, and the hybrid method of accounting, which is a combination between cash and accrual. My recommendation, which is a little bit more work, my recommendation is keep it in whatever system you use, QuickBooks or Sage or Mint. Keep it on the accrual basis of accounting, which means that you have to enter the invoice, because you're going to be able to keep track of who you send the invoice to, how much they pay you, how much they owe you. And then at the end of the year, if your accountant or your CPA is filing the tax return on the cash basis of accounting, it's just a click of a button, and that brings it from accrual to cash. So you don't have to pay taxes on invoices that you have not collected the money yet. So bullet number 3, invoice your clients. My recommendation, do it. It's more work. It's more work. But if you want to be accurate on how your business is doing, do it in the accrual basis of accounting, which means entering your clients' invoices. And then once you enter your invoices, you record the payments that you receive, the deposits, that could be in cash and checks, and nowadays is Zelle. Zelle is the in thing right now, right? Which is great because you get the money automatically. You can record your inventory because you're going to purchase the inventory, you're going to put it on the balance sheet, and then as you use it, and that's where I was talking about tax accounting, is the adjustments you made at the end of the year. Very important, you have to reconcile the bank accounts every month, the same as the credit cards, the same as petty cash. It has to match what's on the bank statement and what is in this software program that you are going to receive, because it gives you a real good picture of what is going on in your business, and it allows you to have accurate financial statements like the balance sheet, the income statement, and the statement of cash flows. In here, we talk about review and reconcile transactions using the general ledger. What I like to do is, if I have a client within the Florida SBDC that they already using some sort of accounting system, even though I only train people in QuickBooks, we run a general ledger, and you can literally see where all the errors are, because I will teach you how to find them, how to find those errors and then fix them. And it's a matter of just learning where should be posted, what category of expense. Maybe it was posted in the wrong account. Maybe automatically, a lot of people, they trust the system so much that they don't take the extra second it takes to make sure it's categorized to the right expense account or asset account, which if it is not categorized correctly, is going to destroy your financial statements. They are not going to be accurate. Manage bank feeds. That means that if, let's say, you decide to use QuickBooks, or you're using QuickBooks already, whether it's QuickBooks Desktop or QuickBooks Online, we can link the bank accounts and the credit cards that belong to the business, so that it makes it easier and faster to enter the data into the software program. And I always recommend work with your tax preparer for tax compliance. Always trust the person and find the right person to help you with your taxes. It's critical to have that information, because it's going to help you prepare those tax returns to be in compliance, either with the state of Florida or the IRS. And once all the compliance is done, whether it's accounting or tax compliance, you can prepare those financial statements and you will be good to go. I kind of mentioned a little bit about the methods of accounting, but we have three methods: the cash basis of accounting, the accrual basis of accounting, and the hybrid method. What is the cash basis of accounting? Recognizes revenue expenses at the time cash is received or paid out. It does not matter when you get the bill from your vendor. It does not matter when you issued the invoice. Is when you receive the cash. Either the cash comes in or the cash goes out. That's the cash basis of accounting. Many small businesses are in the cash basis of accounting, but I hardly recommend keeping your books on the accrual basis of accounting. And like I said, it's just a click of a button. It's just a click of a button for you to make sure that you're recognizing and have your books in order. The accrual basis of accounting recognizes income at the time the revenue is earned. Imagine that you send an invoice on December 31st, and you're preparing the December 2023 tax return. You have to pay taxes on that, even though you haven't received the money, right? But there are a lot of industries that they have to be on the accrual basis of accounting. But we have a lot of small businesses. They qualify because there are certain requirements that you have to have, which the IRS gives you, that you have to be either cash or accrual basis of accounting. I'm going to repeat again: recognizes income at the time the revenue is earned, and records expenses when liabilities are incurred, regardless of when the cash is received or paid. I have an extra X in here. It must have been my fingers doing this on walking, right? And then we have the hybrid method. It's a combination of the cash and the accrual methods of accounting, like I mentioned before. Will the IRS accept the hybrid method? It will, if the combination of the cash and the accrual methods of accounting clearly reflects your income and you use it consistently, clearly uses it. A lot of people, they want to use the hybrid method to avoid paying taxes on invoices that I have received, but this is something you need to talk to your accountant or CPA. Here we are. We have, as a business owner, you have three key financial statements. You have the balance sheet, the income statement. Many people call it the cash flow statement, but the legal name is statements of cash flows. But it's easier just to call it cash flow statement. which let me tell you, it's a secret. If you have, let's say, any software, any accounting software, it will produce them. So you don't have to worry about it. The key factor in here is to categorize the assets and the expenses correctly so the financial statements come out perfect. Now, let's talk about our debits and credits. Remember that I said that we have a formula, we have a T account. This is what's called a T account. Literally, it looks like a T. Whether it is an asset, whether it's a liability, or the owner's equity, they all have a debit or a credit. The secret is to memorize whether an asset increases by debiting the account or whether the asset increases by crediting the account. And this is something that you should memorize. Just memorize this and you would love me forever. Assets always increase by debiting an account. Liabilities always increase by crediting. You're using the T account by crediting the account. And the owner's equity increases by crediting the account. Because if you notice in here, it says assets equals liability plus owner's equity. So if I was to put a little T account right underneath here, the T account will be debit and credit, and I will put an asterisk under debit because that's how my assets increase. And then the liability, this will be a huge T account. This is just to memorize whether it's a debit, how the accounts increase. I will put a huge T account in here, and I would know that my liabilities always will increase by crediting the same as the owner's equity. And the opposite is the truth. So if my assets increase by debiting the account, if I take money out, let's say it is the bank account, right? It's going to increase by you when you make a deposit. But if I take money out, what would be the opposite of debiting? It will be crediting the account. Then we have an example of the balance sheet. The balance sheet, this is standardized. Like I said, the financial statements are the same worldwide. Now, I work with a lot of foreigners in different countries, and they differ a little bit, but the principle is the same. The principle is the same. They all have current assets. They all have fixed assets. They all have other assets. Because if you notice in here, remember the formula before? It said assets, right? So if you go to my assets, now I have all my assets in here. Assets will be my cash. Cash meaning is either petty cash or the bank account or accounts. Accounts receivable. You have a reserve for bad debts because not everybody's going to pay you, unfortunately. That's life. But if you have good clients and you make a good proposal, business proposal, or what you're going to say, and you have it already, the possibility of this reserve for bad debts will be zero. Then an asset as well as the merchandise inventory, any prepaids. What's a prepaid? It will be, for example, I rent this warehouse and they want me to put 1 year deposit for the rent. That will be a prepaid expense. It sounds weird because it's on the balance sheet and it's called expenses, but it says prepaid. That means I have a client that is opening up something to do with beauty at a mall, and they want $330,000 1 year rent deposit. So that would go right here where it says prepaid expenses. Notes receivables will be money that the people owe you. It will be a note that you did some lending and the people owe you money. So that's considered an asset. Then we have the fixed assets. Fixed assets have everything that is tangible. Tangible, a truck, a printer, a computer, some sort of equipment to do the type of work you do. So, and we're lucky enough to be able to report on the balance sheet, let's say the automobile minus that depreciation expense, which is a monthly or annual, it depends on how you keep your books, but definitely is annual accumulated depreciation for the purposes of the tax return. Then you may have furniture and fixtures. You may have some equipment. Maybe the business owns a business. One that is not in here is leasehold improvements. That is also considered something that even if you don't own the property, you can depreciate it. I'm sorry, amortize it. And then you will have other assets like goodwill. Goodwill will be, for example, if I want to buy a McDonald's or Burger King, right? Or I have such a beautiful idea and it grew from zero to millions of dollars. The name, it has value. The name has value, and that's an asset. This is just part of the assets. Then it said, the formula said assets equals liability plus owner's equity. So we go to the other half of the balance sheet, and it's the liabilities and capital. Capital will be the same as owner's equity because the owner's equity includes, the capital includes the owner's equity and the net income for the period that you're closing. So let's talk about a little bit about current assets. We have either long-term assets or current liabilities. We have long-term, we have current liabilities and we have long-term liabilities. So current liabilities is something that you had to pay within 12 months. And that will be accounts payable, sales tax payable, payroll tax payable, accrued wages payable, unearned revenue. What is unearned revenue? You should ask me, right? I bet you're asking, what is unearned revenue? Unearned revenue is, for example, you do a proposal, and on the proposal, you request the person, whoever you're doing the business with, for a retainer. And says, okay, this is going to cost you $100,000, but you have to give me 50%. And they give you the money to start, but you haven't earned that money yet. You have not earned it, so that's why it's called unearned revenue. And that amount keeps reducing as you progress on the on whatever project you're working for. You keep lowering it down because once you do the work, you can remove the total amount or partially. Then we have short-term notes payable, short-term bank loans payable. After COVID, a lot of small businesses, they got the SBA EIDL loan, and that will be going into loan payable. Then we have the long-term notes payable, and usually what I did is I tell my clients, just put long-term SBA EIDL because it's going to take you a while. It was several months that they gave you, years actually, to pay it off. And again, we go back to the formula. We have owners, assets equals liabilities plus owners' equities. We just went over the liabilities. Now we're going to go into the capital. And that's the owner's equity. Owner's equity will be the money you contribute. It will be the net effect of how much you contribute, how much you take out, and that will be what you have invested in the business. And then the net profit is very simple. Is the net income minus the expenses at the end of the period. At the end of the period. Then we have a very good example of the income statements. The income statement has revenues, cost of goods sold. This is where we will be working with the cost accounting to determine, the cost of the products. So under revenues, we have the gross sales. We have sales returns and allowances. It's part of the compliance that you have to have. The account could be there, but that doesn't mean that it has to have a number because that's where you identify your clients so you don't have to, they return your product. Something is wrong, If you have a business where, let's say, you sell the product and there is coming back. So this account has to be here, but hopefully it will be zero all the time. Then for the cost of goods sold is a formula where you have the beginning inventory, which is part of, let me just go back right here for a minute. You see, we have merchandise inventory in here. That will be the ending inventory. But for our purposes, that will be the ending inventory, and every time it changes, right? Because it affects, those are the adjusting entries we do at the end of the year to prepare the tax returns. But during the year, you just start posting the purchases, the cost of whatever freight in, whatever amount of money you pay to bring the products or the raw material to put it together for resale. And direct labor, that would include your employees. It will be also a lot of people, small businesses, they don't consider the time you spend, you as a person, putting the product together. You have to consider that, because otherwise you're not coming out with the right cost of the product. And some indirect expenses will be such as electricity, some office materials that you might have to use. I personally, indirect expenses, I like to break them down, but the type of expense there is. And then we have the ending inventory. Again, the beginning inventory and the ending inventory is more like an adjustment at the end of the year to get the cost of goods sold for the period. Once you get your revenue minus your cost of sales, it gives you your profit, your gross profit. But after you have your gross profit, now we need to talk about the operating expenses. All the wonderful things that you have to pay to make that business alive. These are just some of the examples. That could be more, but mainly this is the majority of them. And this comes from GAAP, right? They tell us, hey, you have to have an advertising. Doesn't matter if you use it or not, it should be there. Amortization, remember the goodwill that I said that if you have the name, you can amortize it. Bad debts is a very good account where that has to do with the returns and allowances of the accounts receivable, where that if you're in the, you can only do this if you're on the accrual basis of accounting, that if someone doesn't pay you after X number of months, usually it's more than 12 months, there's some rules and regular requirements that you have to follow, you can report it as a debt, as an expense. But you had to be on the accrual basis of accounting. But if you're on the accrual basis of accounting and you are reported on the tax basis of accounting, you cannot deduct it. Charitable contributions. If you donate money to certain agencies that are non-for-profit, you can deduct it. Commissions, contract labor, credit card fees, delivery expenses. I don't know if you notice in here, we had freight in. Okay, freight in is to bring the materials for you to work on, to put together a product. But this freight, this delivery expense is freight out. You put the package together, that's part of your cost. Whatever you pay to bring this product or this raw material to put the product together. But then you sell it, and now you're going to ship it to your client. It's called freight out, and it's also called delivery expenses. That's an expense. It's not a part of cost of goods sold. That's an expense. Then we have the depreciation. Depreciation happens when you have bought those fixed assets. Remember that we will put it on the balance sheet, and now you are allowed, the IRS allow you to depreciate based on the cost. Those are subscriptions. When you register a corporation, the first subscription is going to be whatever Google Daddy or whatever you're paying to maintain your website if you have one, or you buy some magazines that are good and needed for your business. Insurance, general liability insurance. Every business requires general liability insurance. Interest expense, you're using your credit card for the business and you don't pay the full amount during the year. At the end of the year, you accumulate interest because the credit card charges money. That is an expense. Maintenance, that will be repairs and maintenance of the building. Or it could be repairs and maintenance of the equipment, which is not capitalized. If it is a small amount, you can put it as maintenance, repairs and maintenance. Now, this miscellaneous, this example came from CCH, which is one of the largest companies that puts together these statements based on GAAP. I personally do not want to see a miscellaneous expense in your books or any of my clients' books, because that is a catch-all account. You put everything that you don't know where to put it. It's preferably to call it suspense or ask my accountant, and then you sit down with your accountant or your CPA and says, hey, I don't know where to put this. I don't know where you think I should post it correctly. Office expense, it will be anything. For example, it could be water you buy for your clients when they go and visit you. It could be the coffee you provide them. It could be the cleaning materials to clean the office or to clean the bathroom. That would be office expense. There's another one, it's called office supplies, which they call it operating supplies. It will be anything that you have on your desk, paper, ink, pencils, pens, anything related to just work in your office. Then we have the payroll taxes, which is deductible. You're the share of the Social Security and Medicare that the business paid for their employees is right here under payroll expenses, including the Florida Department of Revenue. In Florida, charges a unemployment tax. That is a 100% expense for the business, the same as federal unemployment tax, which is 100% by the business. So that will go all under payroll taxes. Then we have the permits and licenses. Every year you're going to renew your corporation, or you have to have a special license to do the type of work that you do in your business. You can put it under permits and licenses. Postages is not used that much because now everything is more or less email, but if you want to do some advertising and buy postage, you can put it all in here. Professional fees, very important. You have to pay your accountant, you have to pay your attorney. Those are the only ones, the only two professional fees that goes in this account. Accountants and legal professionals, attorneys. And why do we have them separate? Because these two individuals are going to receive a 1099 at the end of the year if you pay them $600 or more during the year. Now, 1099s are issued the following, let's say you are closing your 2023 books. By January 31st, you have to have issued those 1099s. And the good news is now that the IRS allows you to do 1099s for free on their website. Then if the business owns a property, the property taxes are paying there. Or if you rent a location, a storefront or warehouse, many times the owners makes the tenants pay part of the property taxes. It's just part of the deal. They have to pay, so it is an expense that is deductible in your business. Then you may have pay, rent. I personally like to have the repairs and maintenance in one account. You see maintenance here and repairs, I like to have it in one account. Then you have the telephone and travel expenses. Travel expenses is if you are in the business of having to travel. Just be careful that in order to be a travel expense, it has to be that you're spending overnight at a hotel. It's not like you're going from, let's say, from Kendall to Doral and you don't want to come back and you stay at a hotel. No, it has to be because it's far away, more than 2. I believe I'm not sure, but I think it's 2,000 miles. And utilities, it would include disposal, it would include water, electricity. And vehicle expenses in here, if you allow me to be your trainer in QuickBooks, I will separate these vehicle expenses in different areas. I will break it down by auto repairs, auto maintenance, auto registration, auto payments, if you bought the vehicle, or auto lease if you're leasing the property, because it's easier. It's easier to keep track because on the tax return, it goes in separate lines. It's not like, the financial statements just give you one line, but when you prepare the tax return, you have to put it in different lines. So what you do is you set up your books in a way that it makes it easier to prepare the tax return. And QuickBooks, you can link your data to prepare the tax returns if you wish to do it yourself. And wages will be just, the payroll, the salaries. And I like to keep my wages separate from the officials, from the officers to the employees. Makes it easier because, again, it goes in different parts of the tax return. Then we have another area, which is you're not in the business of selling assets, but if you have an asset, a fixed asset, something tangible, let's say an automobile, and you sell it as a gain, you can put it in under here, gain or loss on sale of assets. And if you have, which is very rare nowadays, but you still have some banks that allows you to, they pay you interest on the money you have. So you're not in the business of having money in the bank, but it will be reportable under other income, which is called interest income. The net effect of the revenue, the gross profit, we went through the gross profit minus the operating expenses, minus the other income is going to give you the net income or net loss. Now, this net income of net loss is what I showed you, which I'm going to go back and show it to you again on the balance sheet, which was net profit. You see this line in here? Net profit is the line that it will be in here, net income and net loss. The beauty is that when I sit down with you, I teach you how to read those financial statements, that how the balance sheet affects the income statement and how the income statement affects the balance sheet, so that you can make decisions on your business. And then we have
Lillian,
yes.
sorry to bother you. I know we have like 6 more minutes, and I saw that we have a question on the
Okay,
chat.
we can answer that.
Yeah. We have a question that says, did you say that you cannot write off water and electricity?
You can write it off. I mean, we don't call it write it off. We call it, you can report it as an expense. You can, because it's a business expense as long as it belongs to the business. One thing that the people need to learn is to separate their personal expenses from the business expenses.
Perfect.
Now, if they have a home-based business, that is a little bit different, and that will be more for a class that I will, that talks about what is deductible in a home-based business.
And just Millie Santos raised their hand, but Millie, go ahead and write it in our Q&A. Once you write it, then we'll be able to answer it. And so that was all, Lillian. You have 5 more minutes.
I'm going to make it quick. And this is the beauty. Look what I did. I created the cash flow statement. And I'm going to go super fast. It has 3 activities: operating activities, investment activities, and financing activities. And if you look at it here, I'm literally telling you where you can find the information. It says from operating activities, you go and find the net income that is in the net income statement. You find the receivables, the increase in accounts receivables, you go to the balance sheet. And I gave you the formulas to see where that information is coming from. Then we have the investing activities, which is capital expenditures, meaning you're buying fixed assets. And proceeds from the sale of equipment is going to be removed from the book, but maybe you make money. The financing activities will be either if you issue debt or you have debt. And the beauty of this, again, it tells you exactly where to go and find it. There are 2 methods of doing the cash flow statement: is the direct method and the indirect method. The one that I have an example in here is the indirect method because it's the easiest, because I'm even giving you the information. Do's and don'ts. I believe I covered this based on everything that I said before. Learn the basics of accounting, which is what we are trying to teach you here. Find an accountant with experience in your industry. Find the software, which I mentioned, Sage or QuickBooks. Do the books yourself if you want to learn. If you want to just pay somebody else, you're never going to learn. Set up internal controls to avoid errors. That will be the bank reconciliations. And it does not matter how you do it. Maintain records, paper and digitally, of the bank statements, credit card statements, and employee timesheets, because the IRS still requires them. Do not operate without a budget. Run your business do not run your business based on what is on the bank. Do not use the funds that you put it for something else. Use it because you're short of money. It's very difficult to follow these rules because we are small businesses. Do not mix, which I mentioned this before, do not mix your personal assets with your business assets. Keep the 2 entities separate. Work on assumptions, meaning budgets. Make verbal contracts or important business purchases, but it's always good to have something in writing. Have good credit. Start now. Don't wait until you need a loan to build up your credit. Do not disregard your accountants or attorneys' advice on financial. How can you find a CPA, accountant, or bookkeeper? Ask your friends. Who are they using? Find a certified public accountant. This is the website. And when you call them, ask them directly, are you an expert on this? If not, move on to the next person to ask if they have experience in the industry. Find out from the bookkeeper, CPA, if you're going to be doing the books and they're going to be filing the taxes. Very important, because that will consider who will be doing the work. That will be considered how much money you're going to spend. How are you going to be working with your accountant? Face-to-face, Zoom, phone? We don't know. That's the conversation you had to have with your accountant. How do you communicate? I personally do not like tests because as an accountant, I want to keep track of everything by email so that if, God forbid, something happens, oh no, you told me this, and this is what I respond. And that's a good system to keep track. And how much are they going to charge you? How much literally are they going to charge you? And again, you learn our jargon. And the SBA has a beautiful glossary of financial terms that you can visit. And don't forget us. We're here to help you. Give us a call. Lorna already explained to you how you can communicate with us, but this is the information if you wish to have any consulting services from us. Do you have any questions? No questions. That is great. That means everybody understood what I said.
Sorry, there's two questions.
Okay.
One is, can you mention about P&L frequently?
Yeah, income statement and profit and loss statement is the same thing. Let me give you an example. When I was going through my accounting bachelor's degree, they sent me a homework and they said, prepare the profit and loss. And in the books, it said income statement. So I went and spoke to one of my friends who's a CPA. I said, Michael, what's the difference between P&L and income statement? He laughed and he says, it's the same thing, Lillian. Income statement and profit and loss statement is the same. It's just a different way of saying it.
Mhm. And then the other is, if I have a consult with a doctor in reference to a training in some type of equipment like ortho products, and I pay him, that cannot be put as a professional expense?
Not unless that employee or yourself an employee and you had a problem and now the company has to pay. But you need to keep separate. You need to, the business is one entity and you as an individual is another entity. You cannot combine. Now, a lot of people, they do that. They pay with it because they don't have money. Or they never learned that they should transfer money from the business account to their personal account and pay from the personal account. And that becomes a personal expense. It has nothing to do with the business.
Thank you, Lillian. Thank you so much. It's 2:01, so we will be sending this presentation, the PowerPoint, the video via email. Please give us at least 2 business days to receive that email. We also have different events in January, so make sure that you follow us also on our social media platforms. Thank you again and have a great afternoon. Bye-bye.